Okay, let's jump straight into it. We're doing a deep dive into the Q3 2025 sales results for a real titan of European retail. And this company is trying to manage two wildly different realities. You've got operational stability in France, and then this massive macroeconomic volatility in Latin America.
Exactly. Our mission today is to really separate the noise from the signal. We've gone through the earnings call, the whole report,
Right.
and we're going to pull out the data points that, actually tell you where this company is headed, especially since management just confirmed their full year guidance.
Okay, so let's start with that 30,000-foot view. The overall feeling from the call was, I'd say, one of measured confidence. Total group sales managed to climb up 2.1% on a like-for-like basis.
And that growth was entirely food-driven, which really speaks to their core business. Food sales were the engine here, up 2.9% LFL across the group.
And the cost savings.
Crucially, they confirmed they are on track for that pretty aggressive annual target of 1.2 billion euros. That kind of cost control is a huge lever for them.
I mean, 1.2 billion sounds great, but in this environment, are those savings truly structural? Or are they just, masking rising costs elsewhere? Is it operational brilliance or just smart accounting?
It's a bit of both, but the guidance suggests it's real. Management held firm on all their key full-year targets. They're guiding for slight growth in EBITDA, recurring operating income, and net free cash flow.
Holding that line when you've got a key market with 15% interest rates, that implies a lot of confidence in their cost control.
It really does. Now, before we zoom in on the regions, we have to mention one key accounting change.
Right, the strategic review.
Yeah, so their operations in Italy are now officially accounted for as discontinued operations under the IFRS 5 standard.
And for you listening, why does that matter?
It just cleans up the numbers. It means when you're looking at the core business, France, Spain, Brazil, you're getting a much clearer picture without the Italy results skewing the analysis. That disposal should close by year end.
Okay, so with that out of the way, let's drill down into the core markets, starting with France. This is where the story gets much more positive.
It really is. The positive momentum they started building in Q2 is still going strong, and that's remarkable because they were facing a really, really stiff comparison base this quarter.
You mean from the 2024 Olympic Games boost last year?
Exactly. That was a huge hurdle to clear, and they cleared it. The legacy hypermarkets, so excluding the new Corus stores, are the real standout performers here.
And that's down to those 2 years of price investments finally paying off.
That and what they call improved operating excellence. It's the boring stuff supply chain, stock management, but it makes a massive difference. We saw French hypermarket LFL growth up 0.5%.
And food sales actually accelerated.
Yes, food LFL hit 1.7% in Q3, up from 1.2% in Q2. That's a huge sign of structural health in their home market.
So how did that translate into actual market share?
They gained 30 basis points in the FMCG market. That came from the strength in hypermarkets and, some really targeted commercial initiatives like their brand Carrefour anniversary promotion. It clearly resonated.
Okay, but we can't talk about France without addressing the elephant in the room, the Corus integration. This is the short-term pain.
Right. It's a necessary strategic headache. The commercial transformation of those stores is now totally complete. They're all under the Carrefour banner, prices are aligned, Carrefour branded products are rolled out.
But management was pretty open that this is hitting the top line right now. What gives them the confidence that it's worth it?
They're looking at the granular data, not the headlines. They've seen a clear acceleration in traffic and the number of tickets at those converted stores.
And customer loyalty.
The Net Promoter Score, or NPS, has improved rapidly. These are the leading indicators. It's why they're so confident in that 130 million synergy target by 2027. The early signs are very strong.
Okay, so shifting to the rest of Europe, it was mostly a solid story, right?
Yeah, Spain and Belgium were reliable as always. Spain had great momentum. Food sales up 2.4% LFL. They improved their price position, and NPS shot up by 2 points. Belgium was also solid, up 2.1%.
But that stability just kind of falls apart when you look east.
It does. Romania saw a sharp pullback from consumers after the government's austerity measures kicked in. And Poland is still a hyper-competitive, low-margin market.
But even there were some green shoots.
Even in Poland, their initiatives are working. You can see it in the NPS, which jumped an impressive 6 points. So consumers are noticing, even if it's not fully showing up in the sales numbers just yet.
All right, now let's turn to the part of the report that has investors spooked, Latin America. And we have to start with Brazil. This is a pressure cooker.
The environment in Brazil is brutal, and management was crystal clear on the single biggest reason. The central bank's record high interest rates stuck above 15%.
A classic credit squeeze.
Absolutely. It's forcing immediate cutbacks in spending, especially for what they called the most modest households.
And you see that hit directly in their cash and carry format, Atacado.
Precisely. Avocado's volumes went negative this quarter, down mid-single digits. It's just impossible for a format like that to absorb this kind of hit to purchasing power.
But, and this is fascinating, the retail side of the business, Vario, seems way more resilient.
It is. Vario serves customers with higher purchasing power, people who are less exposed to these rate hikes, and that segment is holding up. Hypermarkets were up 3.3% LFL, and supermarkets up 4.0%.
So it's really a story of two Brazils.
A tale of two consumers, definitely.
Okay, here's the point that really made me pause, though. The credit portfolio paradox. Against this backdrop, their credit portfolio at Carrefour Bank grew by 17%. 17%. I mean, in this environment, that sounds less like growth and more like a massive red flag for future defaults.
It's absolutely a danger signal, and investors are right to be watching it closely. The tension is huge. You're talking about debt-burdened households on one hand and growing your loan book at 17% on the other.
So how are they possibly mitigating that risk?
Management was very clear that they've reinforced selective measures. They're being extremely stringent on who gets credit. They say this has, so far, prevented an acceleration in loan losses. But they are walking a very, very thin tightrope.
And before we leave the continent, a quick word on Argentina.
Argentina is just pure volatility. They're gaining market share, which is good, but management basically said forecasting is impossible. They even pointed to the elections happening this weekend as a total unknown.
Wow. When a company says that, you know it's serious.
It speaks volumes.
Okay, so with all these regional battles, the broader strategic moves become even more important. Let's look at their structural improvements.
First up, e-commerce. It is on fire. Overall GMV accelerated by a blistering 36% in Q3.
That's huge.
It is, but the real pivot is in food. Online food sales surged by 62%. That proves their digital investment is really hitting its stride.
So that structural shift is working. Now, what about the less glamorous but equally important work on the balance sheet, that BRL-denominated debt?
This is a massive win they're locking in for 2026. They've nearly finished refinancing 1.4 billion euros of that Brazilian real debt. By converting it to euros, they slash their currency risk and lock in lower interest payments.
And that has a real bottom line impact.
A huge one. It's expected to deliver a 100 million positive impact on net free cash flow and net income for the full year 2026. That is a concrete, non-operational win.
We also saw a move with their global purchasing alliances.
Right, Concordis. They just expanded by integrating a German group, RTG International. This brings the alliance's total negotiated revenue to over 125 billion euros.
And what does that scale actually mean for you, the shopper?
It means enormous leverage. They can negotiate much better terms with suppliers, which helps them keep prices competitive and protect their own margins. In an inflationary world, that buying power is critical.
And finally, they gave us a clearer map of the company's future.
Yes. Italy is on its way out. The three core non-negotiable markets are France, Spain, and Brazil. And they confirmed the strategic review is underway for other countries, like Poland and Argentina, saying there's no taboo on future action.
A clear signal that they're willing to prune the portfolio.
Definitely.
Okay, that brings us to our "This is not financial advice" segment.
And the standard disclaimer applies. We're just analyzing the data, running simulations. We are not offering investment advice, but we always like to game out an outrageous but plausible trade.
So let's set the stage.
Yeah.
The market right now is fixated on two things: the slowdown in Brazil and the short-term top-line drag from the Corus integration in France.
Exactly. And those near-term worries are, masking the underlying strength in their core business and the confidence of that reaffirmed guidance.
So what's the pitch? How do you play this?
We're calling this the synergy acceleration bet. The idea is simple. You go long Carrefour stock. You're betting that management's execution track record means the benefits from that Corus integration will show up much faster than the market thinks. The stock price today is likely discounting the full value of that confirmed 130 million synergy target.
So it's a bet on the difference between market perception, which sees a long, painful slog,
and management's on-the-ground data, which shows accelerating traffic and rapidly improving loyalty in those newly converted stores.
Right.
We bet those signals will clear the short-term pressure much faster than anticipated, maybe by Q4 of this year or Q1 of 2026. This flips the entire narrative from credit risk to proven integration success. It's a classic bet on management execution.
A very compelling idea. So let's bring this all home. What does this deep dive mean for you?
The main finding is that Carrefour's story is really defined by two completely different narratives running at the same time. On one side, you have genuine operational resilience in Europe, backed by smart cost control and big structural moves.
And on the other side, they are fighting this brutal macro battle in Latin America, mostly driven by those crippling interest rates in Brazil.
Exactly. And that tension is what you need to watch. The French stabilization and the e-commerce boom show the big picture pivot is working. But here's the final thought, the critical question for the new year.
How long can that credit team hold the line in Brazil?
Before those high interest rates finally cause a more serious impact on that 17% growing credit portfolio.
That's the tightrope. That credit book is the key indicator of whether the Brazil operation goes from just challenging to structurally dangerous.
A fascinating tightrope walk indeed. Thanks for guiding us through the numbers. We'll catch you next time for the next deep dive.